Hi, welcome back to Trade with Conviction, your shortcut to making sense of the oil market. I'm Felipe Elling Sherman. I'm your host today, and today I'm joined by Jorge and Neil. Hey guys, how are you?
Hey Felipe, all very good here.
Yeah, all fine.
Awesome. Okay, so like we did last week, we'd like to start with geopolitical macro corner. Going through the headlines and news, recognizing that the market is still very much driven or influenced, at least, by all of these macro headlines. And Neil, why don't we start with the risk premiums?
Yeah, let's start with Iran. We're recording at 4:30 on Thursday when flat prices had a massive run up. The situation's obviously getting really hot again. We're seeing reports of very high civilian casualties. Whether or not that is the pretext for the US to be sending its armada into the region, I guess we'll never know. But that is basically what the market is reacting to. It's now reacting to the threat of military conflict imminently, maybe tonight, maybe tomorrow. And it's obviously the related supply threat that is driving oil price. So now flat price is up $10 per barrel versus where we were in mid-December when everybody was getting really short because of the glut. And the question for us today is, is this just a headline-driven thing? Is it a risk premium that's finally going to remain in the market because we're going to get real supply issues? We can't really know. And it's the same story as we've had many times in the last year, where we're kind of left at the mercy of the headlines, so to speak.
Yeah, Neil, not only that, but moving west to Venezuela, President Maduro's capture was a shocker earlier this month. But the follow-up is actually keeping the volatility alive. Secretary of State Marco Rubio is testifying today. The quote getting circulating is that the U.S. is ready to use force to ensure cooperation. Now, obviously, we don't know if that's just noise, threats, and things like that. But obviously, the impact could be if Venezuelan flows that are already messy. If we do have a force happening, that could have an impact on infrastructure damage or tighter sanctions in the interim government, that heavy barrel supply that we started seeing flowing might actually not show up.
Yeah, let me introduce one comment about products because these 2 points on the geopolitical side have impacted the naphtha market very quickly, and you can feel it in the prices already. So on the Iranian picture, we've seen a very big jump on East West. It was already strong, but right now it's at record levels again, the same record levels that we saw last quarter, above $40 per metric ton. And the second one, the Venezuelan story, is impacting on the physical side in the US Gulf Coast. So 2 big areas are being impacted. And we have seen the flow already going from US Gulf Coast into Venezuela to be used as diluent. And we've seen a jump in the cash deals of light naphtha in the US Gulf Coast.
And then not only Venezuela, obviously on the sort of slow burner side, there's the developing story in India, I guess. It's more of a medium-term comment, but it does have possibly direct relationship to how much Russian crude they buy. And that's this notion that we picked up last week, whereby India and the EU are getting closer together. And this week we obviously got this new trade deal inked, which is a pretty big trade deal, including a defense pact that was basically included into this thing, which is quite unusual, I hear. Basically, it solidifies the relationship on trade and geopolitics. For this week, it's obviously a slow-burning background noise type thing for demand stability, but it is potentially something that we ought to it ought to become more and more relevant in case the Indians decide, actually, we actually need to get more and more out of Russian crude buying.
Well, you can only imagine that this is a negotiation, between the Europeans and the Indians. It's like, well, if you want me to buy less Russian crude, what are you giving me in exchange? And this is, I guess, is part of that sweetener, and the defense contracts and things like that is just part of that. Let's see. Indeed, it could have a dramatic impact on Russian crude buys into India. I guess the second point is the dollar destruction. The dollar index has broken down, and we're now seeing 4-year lows dipping into the mid 90s, the levels we saw in the mid 90s. So usually a weak dollar is like a rising tide that lifts all boats. It's good for emerging market demand, and we see that generally in Nigeria for gasoline and diesel. It's supportive, and it's generally supportive for flat price. And we've seen that. I guess it's part of why the flat price is bouncing back as it is right now, obviously linked to Iran naturally. But one has to ask himself, is this dollar weakness coming from good growth signals, or is it a loss of confidence? Either way, this is providing a floor that the physical fundamentals might not justify.
Yeah, I mean, I definitely see it as loss of confidence. I think that's pretty much the trade here, right? It's related to everything else in the news. It's just the pivot away from the US, also financially. So it's something that's unfolding in front of our eyes within the space of weeks, really. On the topic of actual physical outages as well, that's the interesting thing, right? Because we're getting this spike in flat price driven by all kinds of stuff. But it's difficult for the fundamental trader because we know the market's long. We had a few weeks of outages, but now we've got this Iran story that's coming just as all these outages basically stop. So the biggest one was CPC. They're bringing back their floating mooring, the SPM, which will allow them to basically load as much crude as they normally do. And the Tengiz field, which had some issues, basically is also coming back within the next week. So the biggest outage out there in the market is now over. So February should be much better from that perspective. And of course, we had a bit of a cold snap, Arctic weather in the US that brought off a bit of crude production. But in the end, it's just a small speed bump, if you like. So, we're back to the situation where it's geopolitics versus what seems to be a very long market. And there, I just want to pull out a couple of numbers just to define that a bit better. Even if you just look at the US, in the EIA data, in the last 8 weeks on average, the build in total crude and core products has been something like 1.2 million barrels per day. Normally, we get something like 500,000 barrels per day. 600,000. So we're double the normal build. So there is a glut happening in the US, and that's just one country. There's going to be more stuff elsewhere, of course, in China and the rest of the world. But flat price doesn't care about it because of geopolitics, headlines.
Yeah. So the bottom line, I guess, is that we have geopolitical, the geopolitics is screaming buy, but the physical inventories are screaming glut. And that divergence is where the opportunity lives today. So let's dig in. Let's dig into what we're seeing. Let's go to Jorge on the gasoline side. What are the updates, the main events or news that you're seeing right now in gasoline?
Yeah, I think we have many different things to look at this week. Yeah, first of all, like the most short-term impact is the US Gulf Coast is tightening. We are in an environment where contango is strong in every market, and the only rebound that we've seen in time spread has been in US Gulf Coast. This is directly linked to the cold weather, to the furnace storm that we are seeing in the US Gulf Coast. And looking forward, we have stocks that could be considered as tight in the path one. So this can be bullish in the medium term, depending on how the meteorology impacts. Then on the other, as a bearish factor, we have path 3 stocks in the highest level in the last 10 years. So a little bit of counterbalance in there. Then moving to Europe, we are seeing a huge difference between the physical and the paper market. The paper market is really weak. We are seeing it on cracks and on time spreads. And the physical market, we are seeing a stronger component prices, and also item premiums are also rising. The blended margin was open until now, so that justifies the demand for component. But right now, it's closed for almost every option. Maybe some refiners for E10 can do it, but E5 is completely closed, and Intel for blenders looks close as well. And then the last thing, moving to the Asian market, we have seen a very strong sell-off on East-West. We have seen a very strong downtrend since the beginning of the year, and this is impacting the arbitrage economics from every region. And the main reason behind, we have left behind the peak of the turnaround season, and we are seeing a strong export from out of China and also out of AG. And then the last point, I would say on the medium term, we have this story. We talked about this a couple of weeks ago in the podcast, but we have this crude intake shifted to a lighter slate that could be something to look in the medium term.
Yeah, and that is something that I remember once. I don't even remember which year it was. The whole market. This was maybe 2016 or 17. The whole market was extremely bull, and we didn't really realize we had a lot of light crudes and a lot of gasoline product. The percentage of gasoline increased relative to diesel, and we didn't see this coming. And then boom, it dropped like a hammer around September, October. I don't remember, it was 16 or 17, but you started seeing that one additional cargo in the Med, an additional cargo in ARA. Before you know it, it's just filling the market everywhere. So it's something to keep in mind and maybe remind ourselves in a couple of months, because we think about it now, but we don't see the impact, and then we'll see it in 3 months' time.
Yeah, I think it's a good feature that we have added since we add Crude to the tool, because right now we have this medium term view on how the crudes are looking into the refiners.
Fair enough. So in terms of the price action, what can you tell us?
Yeah, the biggest movement is on East West. It has trained 3.5 cents per dollar per barrel, lower since the start of the year, and it's a record historical lows for February and March. So obviously this is impacting a lot the arbitrage perspective, and it's making Singapore barrels much cheaper. And then that would be on the price differentials. We are seeing a little bit of a stronger TAR also because of the weather in the US Gulf Coast. And then from the structure perspective, we are seeing a stronger contango in Asia and Europe, a small rebound in the US Gulf Coast market, in the US market. But yeah, overall, the contango is very steep in every market at the moment. Yeah.
So what is the ARB picture telling us right now?
So as I have said, Singapore barrels are becoming more and more cheaper. They are harming the competitiveness of European gasoline into these outlets where they can compete, mainly into East Africa. We were seeing few options for European blenders in that region, and we are not seeing that anymore. So that's a big change that could point to a support on the east-west downtrend. And then Europe is no longer competitive into East Africa, but it has improved a little bit its competitiveness in the Atlantic basin, since US Gulf Coast barrels are becoming more and more expensive, and maybe there is a risk on the supply in the short term. So European perspective into that region is improving. And then the last thing we have mentioned is that in the beginning is that the margins are now closed for blending locally in Europe for E5 and just marginally open for E10.
Yeah, fair enough. By the way, I was speaking to June this morning, and she was telling me that apparently ARBs now are open from Singapore into places like Pakistan and perhaps other, I'm not sure if East Africa, but I mean, Middle East, East Africa. Is that the case?
Yeah, that's the case. We've seen that there are like two changes in the safe movement. So not just Europe has lost East Africa, but Singapore has recovered more outlets compared to IG. So looking at the origins right now, Singapore is the cheapest one in almost every outlet. Yeah.
Interesting, which is quite rare. I mean, let's face it, Singapore normally is not that cheap, or it doesn't really win versus AG. Everyone, that's quite rare. Which, in my opinion, doesn't necessarily mean that the rebound should happen right now. If the market is positioned short, then that positioning should remain. And let's not forget that Singapore is a pricing center. So it doesn't. If that physical picture doesn't necessarily mean that the rebound should happen now. It depends on the positioning of traders as well.
Yeah.
Timing is if this Singapore remains open into other places, the inevitability of trade flows will have an impact on the market. But if I was trading this, I would not necessarily say, okay, let's go long Singapore right now. You might continue seeing that just because the market is positioned short Singapore.
Yeah, and not even long East West. I think it's too risky at the moment. So we have one bearish factor that is gone, so the competitiveness of Europe, but I don't think it justifies a completely change on the downtrend of East West.
Yeah, fair enough. So we're moving on to a new little section that we have called the trade box, or where we have a specific trade idea. In this case, Jorge, you have one on gasoline. What is that, and what are the factors that drive you to have that opinion?
Yeah, I think the first one, I've been talking with Phil for a while about this. So far, we have seen a very steep downtrend on EPOP, but I think there are some structural changes that we have seen recently. So the position would be long EBOB time spreads, expecting to find some support before the roll into the summer quality. And the main fundamentals in this direction, first is that we are seeing still the physical market much stronger than the paper. Then the US Gulf Coast story with the Further storm and less supply in the western regions. A stronger TAR, but it's also harming the competitiveness of US Gulf Coast. So it's not just that they have less supply available, but they are also more expensive into the outlets where it competes with Europe. The local blend margins are closing. Yeah, and I think that's these are the main fundamentals. Yeah.
Yeah, the only counter here, or a bear case, would be that you're losing all of the east of Suez opportunities to either AG or, in this case, Singapore. I would add to that it's who wants to be short in a market that is already quite in contango. It's like, what is the risk reward there? So you're removing shorts from the market. Doesn't mean that the market is not bearish, but it's just you're removing the shorts, at least the pressure. So there is a potential there. The question is more timing, I would say. I think that you're right, but there's just the timing of it. And if there's any rebound, how long-lived is it? And that's...
Yeah. And I think we talk, in this case, particularly about the February-March time spread. Because then the March-April is going to be a completely different story. But yeah, I think there are several factors pointing on that direction in the short term.
Moving on to naphtha, what's your trade idea there, and what are the reasonings behind it?
Yeah, I think we talked about this in the podcast, I think 2 weeks ago. I keep maintaining my view. So basically, it's a long position. Well, it's linked also to the EBOB time spread one, but it's a long position on gas naphtha for Q2. If we look at Q2 gas naphtha, the difference, they are strong compared to the historical average, but there is a big gap between the current levels and the maximum values that we showed during the last 3 years in a row. So the main story here is that after 2022, with all the war in Ukraine, the market has changed for gas naphtha during the months before summer. So it looks like for 3 years in a row, the market was not ready for such a rally in the gas naphtha. So this is like the main reason behind this. Also, I have already talked about the supportive picture for EBOB, but there are some risks to the downside also on the naphtha leg. We are seeing a poor petchem margins in the east. Ethylene is trading at 2 years lows. And also there is more Russian supply. We are seeing less attacks from Ukraine into Russian facilities. So we could see this story also in the naphtha market.
Fair enough. So on the bear case, to counter a bit what you were saying, I guess that one could argue that the renewed strength on the naphtha arb to the east could be a counter argument to it. Potentially,
yeah, of course.
Disappointing summer of the gasoline complex, but again, it's a bit early to say that. Maybe what we were saying before about the light crudes and the higher gasoline production, but I guess that it will impact naphtha as well. But anyway.
Yeah, the stronger bear case, well, about the summer driving season, we just can make ideas now, but they won't be based on facts. And the naphtha arbitrage today is strong, but it's much weaker than what we have seen it during the previous months. So even if it's open, the margin is much smaller than what we saw during Q4.
Fair enough. Any other trade ideas before we move on to crude?
Trading ideas, I don't think I have more. Maybe you can link the US Gulf Coast story with the Western story for EBOB to think about a potential long in TAR, but it's something that maybe we can explore for another week.
Okay. Neil, moving on to you. What's the headline, if you want, on crude? Let's start with that.
Yeah, the headline is obviously what we've discussed in terms of what's going to happen on Iran, and I'm well aware that anything we say just now is kind of more fundamental and arb based, but to sort of mirror your point on Singapore as a pricing center, when's the timing on any kind of fundamental trade at the moment? It's good for us to go through what has happened to prices, what has happened to headlines, but in terms of trading Brent spreads, for example, it's very difficult, obviously. So it's just to caveat that. But what's happened is, as we said, CPC is returning, and even January loadings I was looking are not even that low. But Tengiz field is coming back, maybe at half capacity next week, and then another half the following couple of weeks. But generally speaking, the big supply outage is now returning. And then the other bit in the headlines is basically what's happening to Venezuela barrels. They've been successfully marketed into the US Gulf Coast, but there's increasing interest from India. That takes us also back to the Indian buying of Russian story in terms of, are they going to really exit more and more? But there's definitely some Indian interest in terms of Venezuelan barrels. It's just depending a bit on price. And I think there's going to be a bit more price discovery to happen over the next week or two, basically.
On the price action, tell us what's happened recently.
Yeah, so the things that really interest us, apart from flat prices, obviously things like the EFS, the Brent to buy, swap, it's the other one, and the TI Brent spread. All those things are really far too wide, right, in terms of far too overextended, and it's all because of the geopolitical premium. What is interesting, though, is that the kind of physical crude market is definitely peaked, even in the light sweet. So the North Sea physical premiums started to come off because CPC is returning, because the ARBs have been super closed out of the region, because TI can flood into Northwest Europe at these levels. And the sour market in the world is also dropping off. So the Western, LATAM, Canadian sour diffs, they're weakening. The spot AG market is more or less weakening. So the heavier crudes in the AG, they're still at discounts to Dubai swaps. And even things like Murban, the benchmark Murban, that has been weakening somewhat unexpectedly, I would say. We thought it looked so cheap that it would have room to run higher, but I'd say it's just weakened. So definitely the physical crude market looks weaker at the time when the flat price is going crazy. And the other thing just to mention is the light versus heavy physical crude spreads. Those are very wide. If you look at something like Ekofisk versus Johan Sverdrup, this time last year they were at parity. Now there's a $4 per barrel spread between them. And that's another thing that goes against light crude valuation, is the fact that there's every incentive to refine more heavy crudes just now. So to kick out things like Murban and Forties and WTI even, and to take in more OPEC and heavy crude, LATAM and Venezuela, stuff like that.
Makes sense. On the ARB picture, what can you tell us?
Yeah, the interesting things, we've picked up a few of these recently, but the only thing to talk about is the status of Northwest Europe, right? It's hyperextended. All the ARBs from WAF, Northwest Europe, Black Sea, they're closed to the east, so nothing can, in theory, move. You've got funny ARBs that have opened up, things like Murban that could, in theory, move to Northwest Europe because of the EFS. It's just a very, very unusual position. And the most concerning for the Brent complex is how cheap WTI is in Northwest Europe. And that's on all vessel classes, right? So if you look at the Afra market, the TT25 is very, very, very expensive, but it's still landing WTI barrels at mega discounts into the North Sea, into Northwest Europe. So everything speaks for Brent coming off. It's just about timing. How do you trade this thing? And the other thing that's interesting is the effect that Venezuela is having on the medium, heavy, sour crude market in the Americas. We're talking about Canadian, Cold Lake, we're talking about LATAM crudes, we're talking about Guyana. Those pop diffs have come off a lot, and they actually can arb into Asia. Things like Mars. Mars is one of the cheapest crudes in Asia, and you wouldn't really expect that to be the case, but it is. So there is actually some crude arbs open to the east, but it's not the ones that you normally look at, let's say.
Fair enough. Okay, so moving on to your trade idea, I think you have a short position in mind. What is that?
Yeah, I mean, the only thing you can really think about in terms of the normal types of trades that we talk about is the things like the EFS, right? And obviously, this week is a time for options traders and volatility traders and stuff like that. But what we have in mind, without knowing the timing exactly, is the EFS, and it simply has to collapse at some point because of various things, but also in case there is outages in Iran, in the Middle East. That's also the sour crude market, which goes in the same direction. So what I have is Northwest Europe arbs are definitely closed to east. WAF arbs are closed to the east. TI is extremely cheap into Europe. Even Murban is cheap into Europe. And now you have physical supply returning. You've got CPC coming back. And so everything speaks for it, for Brent to weaken. On the other hand, on the sour crude Dubai market, you have what could be something like a bull play appearing. You've got Aramco bought a lot of April loading Upper Zakum, And so there is talk about, we'll buy up these cheap spot AG barrels in the hope that they will appreciate in the future. And they do look cheap in terms of the ARB, so it makes sense. And the last thing is that the Western turnarounds, the US turnarounds, the European turnarounds, those are now starting. And certainly the buying for the turnarounds should start to weaken in Europe. So everything speaks for this to correct, except, of course, the major counter-argument, which...
Okay, the only counter-argument is the fact that right now, everyone, whether it's for dollar reasons, for macro reasons, because again, in the past, you also had, when you had like either inflation or geopolitical risk and all that, you buy gold, you buy crude, and especially when dollar is cheap. So, and then you add to that Iran, flat price is just dominating the story right now. And that's the only thing that could be the counter argument to what you're saying right now. Any other, in this uncertain market driven by things that we cannot control, any other trade ideas that you feel courageous enough to share?
Maybe I'll do another one next week, a sort of TI idea, but just another chipping away at the message, which is a few statements of the last day or two about Indian diversification. One is the Indian oil minister, saying India's imports of Russian crude are expected to continue declining. And the other one is the sort of US statements as well. Jameson Greer is the US trade representative, said India's made progress on curbing purchases of Russian, but it needs to do more to satisfy US demands, right? And we can talk all day about whether India really wants to satisfy US demands, but there's lots and lots of statements that seem to suggest India is shifting away slowly.
Okay, well, we'll stick to you, Neil, but moving on to middle distillates. Again, what's the key story that you want to start with?
Yeah, we can keep this relatively short. The main thing is just the weather. Right at this time of year, if you get an extreme Arctic blast, that is the thing that's moving the market. And obviously, there's a demand and a supply component to that. So US refineries have struggled a bit. Baytown has been struggling. And that was one of the supply portion of that was one of the reasons we were trying to be long ice spreads early in the year, right? Because supply had been really, really good and all the risk was to the downside. In fact, we got both. We got really cold weather. And one stat I looked at yesterday was that the cumulative heating degree days in the US are actually already level with the heating season of the last few years, or 24, 25. So it's been really cold, and it's the same in Europe.
Okay. And so what has been the impact on, in terms of prices? What's been the price action here?
Yeah, got a very, very strong spike on the HOGO. That's the main one. Diesel cracks are, generally speaking, up. They've been quite strongly up since the start of January, I would say. And it has also contributed to quite a wide east-west on diesel and jet. So those are the big price moves, basically. It's all basically related to the weather, and probably also a bit of Iran risk now as well tends to turn up in the east-west.
Fair enough. And then the ARB picture, if you can summarize that for us.
Yeah, I mean, it's also unsustainable, right? And we know that's true because the weather will at some stage warm up, unlike the sort of picture in Iran where we don't know how it's going to continue. But in terms of the ARBs, it's done some unusual things. The one is the Northwest Europe to New York Harbor ARB for diesel on various vessel sizes. That's basically the reverse ARB, right? And that's something that never lasts. But when we're talking about our next trade call, what's still a bit strange is that the Gulf Coast ARB to Europe has not closed, or hasn't been closed for long, because the Gulf Coast diff itself is very, very weak because there's a lot of stock in the Gulf Coast. That's also similar to gasoline, really, really much higher than normal. So the ARB into Europe from the Gulf Coast is open, and ARB into Europe from Sikka also remains open. So it's a bit of a weird one when we come to talking about how to trade this a little bit.
So I guess that your trade idea is going to be, let me guess, short HOGO.
It is going to be short HOGO, but when we list out the factors, it actually becomes kind of interesting. So the bull case for the HOGO, or I can do the bear case, the short HOGO case.
Yeah, since you're doing the short HOGO.
Yes, yeah. So the short case would be the fact that you have this very unusual reverse ARB going on, one that never lasts. The other obvious one is that the weather will warm up, but actually what's happening is that the timing is getting a bit strange. The chances of another cold spell appear to be rising for the middle of next month. So that makes it slightly interesting, but at least next week it's going to be slightly warmer. And the other thing is that we have seen some counter-seasonal builds already in terms of diesel stock in Panzer 1 and 2. So they're a bit better supplied than we were perhaps a month ago.
I guess that the bull case for that short HOGO position would be the start of the US Gulf Coast turnarounds reportedly being very strong. Potentially, the question mark is this the right timing? Weather remains quite uncertain, as you were saying before. There's another cold snap coming along over the next 10 days. The US Gulf Coast, Northwest Europe are reopened, as you said, because of the stocks in the Gulf Coast being extremely high. And as you mentioned as well, the SICA Northwest Europe remains open and SICA pointing west. So obviously that puts more downward pressure on the gas oil or gas oil spreads.
Yeah.
So, but yeah, okay. One to monitor, and maybe let's see, who's right, who's wrong next week. Finalizing, so we want to do a quick fire round on fuel oil. Our good friend Hua is not in today, but let me share his thoughts. So just a couple of points that we've been looking at today. The physical market is a bit firmer than it was over the last 2 weeks or so. We've seen some recent Dangote cargoes that have gone to ARA or to the Caribs, which also showed as a workable break-even in our tools earlier this week. And that helps clear quite a bit for the Singapore market, and it feels a bit more supportive now. However, we're still not particularly bullish in any way due to mainly the Rotterdam-Singapore 0.5 hours being closed only by $5-6. And that can easily shift if Singapore gets slightly stronger. Dangote can therefore be incentivized to point back to the east in that case. So something to monitor there. We also have the 0.5 cracks that are still very poor, lots of medium sweet supply in town and not enough conversion cap to take advantage of that healthy RFCC economics. Turnarounds in Europe are coming and may well open up the arb to Singapore again. So that's things that are making us feel that it's not yet particularly bullish for now. So that's the quick fire round for fuel oil. And I think this is over. No, this is it. Once again, guys, we're doing our first live podcast during IE Week. Invitation or the link to sign up, you can find it in LinkedIn and where we post things. And we'd love to see you guys there, as many as possible. And yeah, that's a wrap for us today. Thank you very much, Jorge. Thank you, Neil. And we'll see you next week.
Thank you.
Cheers.